Well, kia orana, tātou katoa, tēnā koutou katoa. Thank you everyone for being here at Tiputi Amatua, the Reserve Bank of New Zealand, and I'm Adrian Orr, I'm the Governor and Chair of the Monetary Policy Committee. I'm here with Karen Silk and Paul Conway, also members of the Monetary Policy Committee, and the rest of the committee are here with us in the room today. So thank you, and thank you staff for all of the work in what I will always and forever advertise as a great read, the Monetary Policy Statement. It is full of rich information. The projections are ours, are of the committee, and I encourage everyone to read. It is a wonderful public good. Today, the Monetary Policy Committee agreed to ease the level of monetary policy restraint in New Zealand, and that was by reducing the official cash rate to 5.25%. The committee also agreed that the pace of further easing will depend on its confidence that pricing behaviours remain consistent with a low inflation environment and that inflation expectations are anchored around the 2% target. Our recent announcements have talked about the committee's growing confidence that rising spare capacity in the economy and changing price-setting behaviours would reduce inflation and enable a future easing in monetary conditions. And it is here today that I can say this confidence has now reached that point where the committee has been able to act. Our economic projections are our best estimates of the future path of monetary policy, and they are always conditional on the available data. This is why we're back every 6 weeks or so talking about our monetary policy outlook. In talking to this outlook, economic growth remains below trend and inflation is declining across advanced economies. Some central banks have already begun reducing policy interest rates, and imported inflation into New Zealand has declined to be more consistent with the pre-pandemic levels. Here in New Zealand, annual consumer price inflation is sustainably returning to within the committee's 1 to 3% target band. It is so pleasing to be able to make that statement on behalf of the committee. Surveyed inflation expectations, firms' pricing behaviour, headline inflation and a variety of core inflation measures are all moving consistent with low and stable inflation. Yes, services inflation remains elevated, but this is also expected to decline, both at home and abroad, in line with the increased spare economic capacity. The committee is in a confident position to sustainably achieve our inflation remit, and we will continue to act as the data evolves. That ends my statement, and we are open for questions. Thank you.
Kia ora, Governor. Katie Bradford from One News. How much of a line call was today's decision? How hard was it, and did you really feel the pressure given the tough stories we're hearing out there?
I kind of used words like relief and pleased, kind of almost borderline on emotional words, that we are at a position where we are confident that inflation is back within its target band and that we can continue, now commence our renormalisation of policy interest rates. So in that sense, it was not a difficult decision and it was full consensus. It's been about building the committee's confidence to get moving, and we're at that point now.
How worried are you about the economic situation over the next few months? Are things going to get worse before they get better? Because obviously it will take some time for this to make its way through the economy.
Yes, our economic activity, it's kind of interesting actually. The darkest period is actually where we are right now. We are still waiting to hear our June GDP quarterly growth rate. That's, months back. And we're in the middle of the September quarter. We have a -0.5 and a -0.2 growth rate for those two quarters, meaning there is a significant spare capacity developed in the economy. But our projections from there on forward actually see New Zealand returning to a circa 3% growth rate 25 and 26. So economic activity renormalising as interest rates come back down and the inflation pressure taking out. So, it's darkest before dawn, and I'm suggesting we're basically in dawn at the moment, according to our projections.
Junaid Tibshirani from the Herald. Did the committee consider cutting by 50 basis points given the, low economic growth or lack of growth?
Yes, we always test ourselves hard on a range of, what is the decision and then what are the chances either way. I have to say there was the consensus was for 25 basis points. It's because, we have a series of further visits between now and the end of the year, October and the November monetary policy statements, and we're really keen to see the actual CPI inflation data and things evolve. So going from 5.50 to 5.25 is a strong start, but it's a reasonably low risk start for the committee.
And just rewinding back to May, was the Reserve Bank wrong or bluffing or a bit of both?
No, we weren't bluffing. The forecasts were well buffed, and but not bluffed. Where we always put out our best foot forward for where we see the rates going. Back in May, where were we 5-6 months ago? We still had headline CPI inflation north of 4%. We had inflation expectations away from the midpoint of the target. We had services inflation very high. And we only had that spare capacity starting to emerge. We talked about the risks both in May and July that those near-term pricing intention risks could well be usurped by stronger than a sharper than anticipated decline in activity. And that's what we talked about in July. That started to play out, and in July we opened the door to say we are getting more confident to start moving rates to a lower place.
I mean, I appreciate it's a very dynamic environment, but what do you say to people sitting at home watching these press conferences or reading the paper, watching TV, when the Reserve Bank says this is likely what's going to happen to interest rates, and then we have something so drastically different happen?
What I would always remind them to do is you don't have to wait for third parties to tell you what to think. You can go direct to the Reserve Bank's monetary policy statement. And when you read that, you will read, in particular, the record of the meeting, which talks about the risks and the conditionality of forward forecasts. And those risks were very strongly highlighted in May and again in July. And, this is just the nature of turning points. So that's it. By the way, I think more people have voted with their feet, and financial markets have been shifting anyway. I mean, we are seeing the tenor of mortgage borrowing having shortened up considerably, i.e. people were sniffing a lower interest rate environment in the future.
Jenny Ruth from Good Returns and Just the Business. You left your quarterly OCR forecasts unchanged through 25 and 26, but that was CPI forecasts. They're all unchanged through those 2 years, and yet you've moved the OCR forecasts by as much as a percentage point or so.
Yeah. No, that's correct. So we're always, the inflation reaches 2 and remains at 2 because we are altering monetary conditions. So our inflation forecast is conditional on monetary policy.
That's a huge change. I mean, it begs some sort of explanation.
Well, it does. There's a 42-page explanation here, and I invite people to read it. And no, it's not a huge change. A change of where you have, 150 basis points. I mean, we're not even back at neutral in this forecast period. So I strongly suggest it's not huge. It is a gradual normalisation, a gradual tempering of inflation. We move on, please. You need to understand the endogeneity of the forecast, Jenny.
Today got something like 3 or 4 questions. I've only had a chance to ask one.
Sorry?
Can I ask about the unemployment projections?
Yep.
You've got it slightly higher than previous, I think, peaking at 5.4. How confident are you that it's only going to get to 5.4?
Bands of uncertainty around that. A lot of the reason why our projected unemployment rate is higher than when we last published a projection is because of where we currently are. Economic output has declined much more rapidly for reasons that we elaborate on in the document. So we're seeing a slightly higher peak to the unemployment. I do say that the quicker pricing expectations, pricing behaviours change, the less need for rising unemployment to achieve the monetary policy we want. That is an important message to price setters.
Afternoon, Governor. Jason from News Talk ZB. Just wanting to ask about the level of pressure, particularly from your friends across the road. We've had various different examples of associate finance ministers either indicating that you should cut the rate or outright explicitly saying that you should be cutting rates to provide relief for New Zealanders. How much pressure did you feel from lawmakers, and did that factor into your decision at all?
Great question, and I'm really pleased to say, and I know that the Monetary Policy Committee would agree, no pressure.
Zero.
No pressure. We focus on our task. The remit is given to us, and we have to put our best foot forward to achieve that remit. So I think it's a wonderful strength of the Reserve Bank's independence that politicians and other people can talk about what they should do or what we'd love to do, because it's not impacting the actual decisions that we need to make.
Yeah, and just very, very briefly to follow up, Chris Luxon has tweeted mortgage rates relief is on the way because we have delivered lower inflation, the we being the government. So I'm wondering if you could speak to the level of the government's role in today's OCI reduction.
Yeah. So, I certainly can't speak to what the Prime Minister is saying, and I'm not aware of that. I would kind of cheekily say success will always have 1,000 fathers, so I don't mind who wants to put their name to succeeding to low and stable inflation as long as we get that. The fiscal policy story is it's given one of the special topics. And, the long story short, it comes out about neutral, the most recent budget, on monetary policy decisions. Clamp down on government spending, contractionary, tax cuts, expansionary, net, about neutral for our monetary policy decisions.
Thanks, Governor. Luke Malpass from The Post. In November, you said that people out in the New Zealand economy needed to cool the jets. Which jets have been cooled the most over the past few months?
Consumer spending, I would say, is down considerably. You think it's down in aggregate, but then you divide it per capita, it's down significantly. To have such a strong growth in migration and to have declining consumption is doing it tough. That's a cold jet.
And as another cold jet, you mentioned before, more contractionary fiscal policy. I saw that the line in the decision was saying that, alongside restrictive monetary policy, early or a larger impact of tighter fiscal policy could be constraining domestic demand. How much data do you have on that at the moment? How much of that is sort of educated guess first, what you're seeing coming through?
It's about 50-50, actually. I mean, the important part is that the first part, government spending, has been well signalled and been underway for quite some time, from late last year and on an ongoing basis. So some of the reduction from the government spending side has already occurred, but there is still more ongoing. The challenge for us was we can see that, and that's good, we understand that. The challenge, of course, for us is what was going to be the scope of the tax cuts, and now we say, and what are people going to do with them? In there, we talk about these concepts of multipliers and how much people are going to spend from this, and we think it's going to be reasonably subdued, given the broader economic context. So our working assumptions are in there. I think, what are we, the spending 0.5 of what they're receiving? Is that the... Yeah.
Yep. Tom Polstraker from the Post. A first question for Paul Conway, and then maybe a quick one for you, Governor. Paul, you suggested after the May MPS that a slightly mechanistic OCR track may have thrown people off a bit off course in terms of what to expect. Have you made any changes to the OCR track this time, and can we rely on it a bit more, perhaps, than we did in May? And just for you, Governor, sort of keen to get a sense of how important it is that rate cuts are reasonably smooth. ASB are forecasting the signals a sort of steady decline in interest rates. Has that been a factor in the decision to sort of create a smooth downward path?
Well, no, we have not made any change into how we think about the OCR track or how we use it to signal the likely path of future monetary policy decisions. And as the Governor mentioned in his opening remarks, the full committee stands behind that track.
And what was your one? I can't remember. What was my one?
The question there was how important it was to have that sort of smooth track down.
This really comes down to the conditionality of the forecast. This is why monetary policy is a learning game and it's a repeat game. So as the data comes through, we've been very pleased at the committee that the economy has normalised more post that global hiatus of previous years. So the economy is responding, more normally to the monetary policy activity on the way through. What you're seeing in that forward path is us taking a measured approach to reducing the monetary restraint, getting back to neutral on the way through. The good news is we can be learning as we go through that around actual data, which has been, crazily volatile over recent years. So that's the main part. Yeah.
Kia ora, Governor. Anand Zaki from Radio New Zealand. Can households be hopeful that we can return to an era of low interest rates that we saw leading up to the COVID pandemic, and then, of course, at the start of the pandemic for other reasons? But is the era of low interest rates going to come back?
As long as inflation remains low and stable, you'll have low and stable nominal interest rates. And so, with that, I think our projection is saying we are going back into a period of low and stable inflation, subject to any other external shock. And that means that you will see lower nominal interest rates coming back into the economy. So that's the case. We haven't quite started worrying about having negative interest rates yet. Remember those stories, but we are far more confident that our neutral rate is around a 3% official cash rate level. So if you think about that as being neutral on average, we are heading back to that.
Governor, it's Ben McKay here from Australian Associated Press. The growth forecasts have been revised a long way down for this current year, Q2 and Q3, now in predicting another recession, so the double dip becomes a triple treat. Can you say what's behind that? And if the goal of monetary policy in this situation is for a soft landing, can you say you've actually delivered that?
So what's behind it? Monetary policy has been tight and has been restraining growth. That is a significant part. There are other drivers of economic activity as well, the government's spending decisions. And on top of that, you've had net migration from from zero to extremely strong, back to something below average. So there are significant drivers of near-term economic activity. Most of the change in our forecasts are not really about our projections, it's about the here and now, the starting points. And this is where we've taken a lot of comfort from the broad range of near-term indicators that are consistently soft, and in some cases exceptionally soft. So rather than waiting for a June GDP figure or a September CPI, we are taking on board high-frequency data that is consistent across the board of weaker activity. So that's the story, and I don't know how to answer your other question, really.
Governor, Bernard Hickey here from the Kaka and the spin-off. I really enjoyed Box B. I'd give it 5 stars, I think, if I had to review it. In here it says the updated assumptions mean that fiscal policy added slightly to medium-term inflationary pressures. Could you have cut earlier and more if there had not been tax cuts adding to inflation?
I don't get involved in the hypotheticals. I think a really critical, important part of May and of July is the near-term starting point for actual CPI. Core, headline and inflation expectations and pricing intentions were still inconsistent with us achieving our target.
And in the section about inflation, it mentions that administered inflation has also been high. Could the government have done more to avoid that administered inflation and help you out?
I'm not so sure about core government. There is a combination of prices that are just indexed, prices that have tariffs, taxes. There are regulated prices that are only reset once a year, local authority rates, etc. And then there are other administrative prices like insurance, etc., that are shifting with the economic winds, etc. So it's quite a broad church of administered prices. Our concern there was when you're at high inflation, which we're no longer, when you have heightened inflation expectations, the longer these one-off events keep actual inflation up, the harder it is to win the inflation battle. And so, in fact, Mr. Conway, your speech in June, do you want to just quickly talk to that?
So in June, I talked about around the risks around the May projection, but also about, in terms of services inflation, non-tradables inflation, we split it into 3 categories, for services that where the prices respond very quickly to monetary policy, and then a second one where it's sort of more moderate, and then a third category where we don't see much change in prices there in response to monetary policy. And what we've seen since then is not only is that sort of high frequency prices coming off or continuing to come off, but also that second category of more persistent prices in the economy are starting to fall currently, which again gives the committee confidence that we're going to achieve our objective. But there'll always be that sort of hardcore prices that don't respond to monetary policy for other reasons, the relative price shifts in the economy.
A really interesting one that we chatted about and feel more comfortable with managing if we're actually in a low inflation environment are the announced changes to electricity prices next year and then the following year. Well signalled, well understood, but significant and widespread. And so, again, you're more confident about a look through that if you have well-anchored inflation expectations.
Just finally, on that electricity, it may be a bit late for your forecasts, but how much impact do you think there might be both on inflation and on output from this spike in wholesale electricity prices and the closure of various plants?
We haven't taken any time looking at that. What I'm referring to were the announced price rate changes
From the Commerce Commission?
Yeah. Commerce Commission.
That they announced. Those price changes are in our CPI track.
Yeah.
But
that's where you'll see some excitement around the 2, where it goes 2 point something and then back again. And really it's these lumpy bits feeding through that we know about in the future.
Yeah, because inflation expectations are well anchored now, we can have a relative price shift like that and it doesn't threaten inflation being at target. It passes through.
Cool.
Lucy from Reuters. If inflation is back in the band this quarter, which is what you're forecasting, real rates are going up even with this cut. Could we see more aggressive cutting in the coming months?
Yeah, I mean, that's, you're spot on. I don't know about more aggressive. It's going to be data dependent, without doubt. But you're right. It is a reasonably safe first step of the monetary easing. We've seen some loosening overall in monetary conditions. We are moving forward with the OCR. An enormous amount of forward is already priced into the markets. So, we're in a strong position to move calmly, I would say.
You talk about domestic inflation in the statement. and it's obviously been stickier than broader inflation. Are you hoping that it gets back to the target, like a 1 to 3%? Do you have a sort of idea on how quickly you would like to see that? What are the problems there?
And so in our projections, we do outline headline CPI, and then we split these into these amorphous things, tradable and non-tradable. Non-tradable largely the homegrown consumer side. And that is still north of 3%, but all of our indicators and measures of it have it declining. Some measures are actually below 3% now of domestic inflation. By the end of the forecast, that is still the bigger part of the total CPI inflation. I think we have non-tradables inflation at 3.5% and tradables inflation at 1.5%, or something there or thereabouts. It adds up to us being bang on target, and we're happy. Yeah.
In May, you were projecting a cut next year, first cuts next year. Now we're looking at a cut today. What went wrong? Is this like a mistake that you made in May? What happened?
I think we explain it extremely well here, and I would hope that you read it, because it's the first 2 paragraphs of the document that talk to exactly what we were talking about in May with the risks around, how we altered that in July, and how it has now enabled us to act in August. So these are just very standard turning points in an economy. People, please understand the conditionality of economic forecasts. You need to get that across to your listeners.
But aren't many of the economic forecasts that you made in May quite similar to where they came in over the last few months?
We've been remarkably pleased with, for the last 2 years, of how the economy has broadly panned out, in fact, remarkably panned out, how we have been anticipating. If we go back to Rebecca's, was it? November 22, we were talking about an economy that looks almost exactly where we're sitting today.
The Governor, as he said earlier, yes, you're right, those New Zealand statistics numbers did come out as we anticipated they would be in May. They're lagged. They're talking about historic situation. What we've had the benefit of between May and now is increasing evidence from high-frequency indicators that the economy's weakening.
Their pricing intentions have declined.
And they were the risks that were called out in May. They've begun to evolve in July, and we feel a lot more confident now, and that's why we're able to now cut interest rates.
Hi, Dan Brunskill from interest.co.nz. I don't want to dwell on this too long, but the change in policy is huge. It's almost an entire year early, the cuts. And you're doing that solely on what people call second-tier data.
Yeah.
Previously, you've signalled that you need to see actual hard numbers in non-tradable inflation and core inflation, and now you're seeming quite happy to move on
in May,
indicators.
we didn't have a CPI at 3.3%. We didn't have core inflation declining and all indicators of core inflation declining. We didn't have inflation expectations anchored at the target rate, and we didn't have price-setting behaviour consistent with low and stable inflation. We now have all of those. So that is a material shift in the confidence the committee has that monetary policy is working. For us to have talked about a cut back then would have been us being negligent to our role of what we were trying to achieve. The projection line was a line that said, we think we're going to have to be on hold for some period of time. There are risks near term to the upside around inflation expectations. There are risks in the medium term to the downside to economic growth. We're now fast forwarded into that period, and the risks are now more balanced.
So would it be fair to say, because you've said previously that the risks were balanced, is it fair to say that the downside risk scenario is the one that is emerging?
No, because we're targeting inflation, and inflation is coming back sustainably into the target range. So I don't see that as a downside risk. I see that as monetary policy succeeding. If we can keep that there around this period, then fantastic.
Sorry if my question was unclear. I was saying previously you said we'll hold rates out until late next year, but we see up and downside risks to that forecast. Now you're saying we're going to cut much sooner. So presumably we're on the, we're calling it the downside risk as in lower inflation.
Yeah, so what we're saying is that the near-term growth weakness is here.
Yeah.
Yeah.
And at the same time, those concerns around pricing intention and expectations have dissipated and actual inflation has declined. We're talking about an inflation rate in our central projection of 2.3%, I think, for the September quarter. What a degree of confidence that type of number gives a central banker relative to what we were talking 4 point something in May, where we were, sorry, always looking.
3.
Well, we got to 3.3, but we were, So, it is a good news story of pricing behaviours changing rapidly.
And just last question, it wouldn't be interest.co if we didn't ask. House prices, do you think that this decision could send them up quickly, and what risk does that pose to inflation?
Yes, well, we don't have a house price inflation target, so we're focused purely on consumer price inflation. We worry about house prices to the extent it impacts on consumer price inflation. Our running assumption through this document is that they remain pretty flat through the period. So.
Hi again. My question, basically coming off what Dan said, is about house prices. How worried are you then about people getting a bit trigger happy, getting a bit excited now they're seeing rates going down and the housing market going up quite quickly? We're already anecdotally hearing, that interest is picking up a bit.
I can't give any of my emotions to them. Just be smart. Just think back, 2 years ago? So...
Do you think this will help?
Look, I would say we're in an extremely low credit growth environment, and you've got banks still making assessments around people's capacity to service debt at levels that are substantially higher than current mortgage rates. That's not going to change in a hurry. So people are still in a position where they need to be able to demonstrate debt serviceability in order to be able to take on additional debt. So, whilst we've got a cut in interest rates here today, and we've had some almost immediate response come out of some of the banks in terms of reducing mortgage rates, we're still in a very restrictive and very confident that we are in we've got restrictive financial conditions there. So you need to keep that in mind when you're thinking about things like house prices.
Yeah, and I think important as well to your viewers, the forward path for interest rates are actually even lower than our forward path for the OCR. So that has already been in the market.
Yeah.
Which is why you're seeing such a muted market response to this activity.
Yeah, and I guess on the flip side, how worried or what's the data saying about the increasing number of mortgagee sales and business liquidations and so forth, and that trend might continue for some time yet?
No, we expect that trend to continue. The financial stresses lag economic activity, and so that's what we look at in our financial stability reports and our assessments. We have a projected non-performing loans to still increase from where they are, but to remain at reasonably low historical levels. Nothing that threatens the financial stability of the country, but certainly puts financial stress on some households.
Luke Malpass from the Post. Are you travelling to Jackson Hole next week, Governor?
No.
Okay. I noticed some comments from the Bank of England Governor Andrew Bailey a couple of weeks ago, and he said that he's not giving any view on a forward path of interest rates, basically saying meeting by meeting would take the data as it comes. I mean, do you think that we're, as a kind of a more macro trend, is that more the world that you think that you're in now as central bankers?
No. I think central bankers that provide forward paths wish they didn't. Those that don't wish they did. There is no known practice. We've had a long-standing practice here of putting our best foot forward out, subject to people understanding the conditionality. When the facts change, the decisions change, and that's what we are working through always. That has worked very well for us. I've heard central banks who do scenarios wishing they didn't do scenarios because everyone focuses on that one scenario. So, it's horses for courses. I think the Bank of England most recently bitten by a review that said you need to have an endogenous path or something. So, everyone's doing things slightly different.
Hello again. And
Last question.
Apologies for the simplistic nature of the question, but I was just wondering if maybe you could help me understand that on one side we've got interest rates from the bank, as you said, coming down, and also we've got the government providing tax relief as well. Both of those traditionally would be inflationary. However, the Reserve Bank's suggesting that inflation is going to hit that or get close to that midpoint. I'm just wondering how to square that circle.
Well, for a start, monetary policy is still restrictive. It's just less restrictive, so that helps. The government spending is also restrictive and declining, so that in large part offsets the tax cuts, which may add to spending. Meanwhile, with rising unemployment and slow credit growth, business growth, it's a quiet environment. Spare capacity has opened up in the economy, and it means we can grow without driving inflation as we chew up into that spare capacity. Does that help?
Yeah, it does indeed. And just as you leave today's press conference and finish with your meeting, do you feel any sense of a relief of pressure now that you finally pulled the trigger on an OCR cut?
Yes.
Why is that?
Because it means inflation is going back to where it's meant to be, inside 1 to 3%. So does it mean we will be any less vigilant? No. So, of course, it is painful. Inflation is no one's friend, and we are getting rid of it. So that has to be a good thing. Thank you very much, team. All the very best. Before you go, I am a terrible marketer. First of all, I'll just repeat. Please read, especially the record of the meeting that captured a lot of the uncertainty. And also I am keen to share that Te Pūtea Matua, we are going to be hosting the Monetary Policy Challenge for all secondary schools at the end of this month. That challenge is going to kick off with a public webinar, which of course the public is invited to, where you will hear people discuss the monetary policy statement, some of our wise economists here. Some of them will even share what it's like to work here, to encourage excitement amongst the schools to be central bankers. How am I doing on my pitch? Tune in Wednesday 28 August, 11 a.m. for 1 hour. Be wowed, and tell all of your secondary schools, get involved, get online. As Tina would say, the internet, it's everywhere, and join in on the Monetary Policy Challenge. Kia ora.